Welcome to the Purposeful Wealth Podcast, the go-to podcast on how to bring clarity, contentment and certainty to your financial life. Brought to you by Jonathan Gibson, founder of Wells Gibson and author of the Purposeful Wealth book. Pick up your copy of Purposeful Wealth on Amazon and please enjoy this show.
Welcome to the Purposeful Wealth Podcast. I am your host, Jonathan Gibson, and today we are going to answer the question, what is the Scourge of Investors? However, before we do, I just wanted to share that last week I was in London attending a summer investment conference which was hosted by Dimensional Fund Advisors at the Langham Hotel, and it was a truly wonderful and inspirational event where we listened to David Booth, the founder and chairman of Dimensional, as well as two incredible professors, Professor Darrell Duffy from the Graduate School of Business at Stanford University, as well as Professor Douglas Diamond, if I remember rightly, from the University of Chicago. And he's a recent winner of the Nobel Prize in Economics. So it was truly a wonderful event, and so glad to have achieved it. Attending these events just really helps to reinforce what Wells Gibson does as a business and why we believe so passionately in the world of systematic evidence-based investing. A few things that I found quite incredible really about attending last week is some of the facts that are shared, in particular that during the Great Depression, which was around about 100 years ago or so, there were nearly 10,000 bank collapses. And during the financial crisis, which most of us should remember, there were 500, and yet there were only 3 bank collapses during the Silicon Valley Bank crisis, which was obviously very recent. But a quote that really resonated with me was a quote from David Booth, the founder and chairman of Dimensional. And David is quoted as saying that having a good investment experience is about more than returns. What matters just as much, maybe even more, is how people feel along their financial journey. And that's really what our business is all about, helping our clients live better and more fulfilling lives. Well, David, and to our listeners, I couldn't agree more, because certainly at Wells Gibson, we certainly believe that real wealth is living a fulfilled and meaningful life. And all we really try to do in our capacity as financial planners is really to help people and help our clients enjoy a successful investment experience. So, on to today's podcast and this question, what is the scourge of investors? Well, unfortunately, as humans, we are poorly neurologically wired to be good investors. We seem to be hardwired to promote survival instincts such as fight and flight, fear and greed, and an aversion to losses. They help us to survive, but they can really lead us into bad investment decisions. For many investors, a propensity to place too much weight on recent events in terms of what the future may look like is quite common. And this is known as recency bias, and it is this which we regard as the scourge of investors. Charles Schwab, a major US broker, sponsors some research of its own or on its own client base to identify which behavioral biases predominate in their clients. And recency bias was the one most commonly exhibited. Around 50 to 60% of all investors appear to suffer from recency bias, and the number is even higher for younger investors. And I just wonder if this is possibly due to the influence of social media. Who knows? But let's look at an example of recency bias in action. Some investors may include global commercial property, such as shopping malls, offices, data centers, in their growth assets portion of their portfolios, just to provide that little bit of diversification to their pure equity exposures. So by commercial property, we mean shopping malls, offices, industrial buildings, logistics hubs, and data centres. And it is the case that investors will often include global commercial property as an additional asset class within their portfolios. But it's not guaranteed to work all the time, but can be beneficial at times. And the logic and the empirical data certainly supports a reasonable case for including global commercial property. And certainly at Wells Gibson, the growth part of our portfolios includes an allocation to global commercial property, and for good reason. But of late, it's true that global commercial property has been under pressure on account of changes to lifestyle and work patterns, which has probably in truth been driven, or certainly in part been driven by the COVID lockdowns, which we all experienced very recently. And then add in rising interest rates, or rapidly rising interest rates, and the story sounds quite bleak. And in 2022, global commercial property as an asset class was down in value by around 14%, whilst the UK equity market was up about 7%. And to add to that, global commercial property is down again in 2023. So many investors might be tempted to consider abandoning global commercial property as an asset class because they believe the future obviously looks bleak, and its recent return or recent run of poor performance is thus likely to persist. But what I would say is that doing this would simply ignore a central tenet of systematic investing, that all this doom and gloom is already reflected in market prices for global commercial property. In other words, global commercial property might go higher or lower from today, but not because of what has recently happened, but because of what new information the market receives. Every asset class has its bad and good periods, yet global commercial property has been the most consistent when compared to developed and emerging market equities over the past 20 years or so. A rational investor might reasonably want to own all three of these asset classes in some proportion, but abandoning or adding to a portfolio simply by extrapolating what has recently done well or badly is not a great strategy, and is likely to lead to constant portfolio change, less well diversified portfolios, and sadly poorer outcomes for investors. In 2022, for instance, commodity futures, after many very poor years, were a star asset class which returned around 30% in a year when bonds and equities were down in value. Yet in 2023, this year, they are down in value by around 15%. And of course, there's always the case that when gold rises in price, investors are always curious. And we know that from history. As investors, we should never fall into the trap of thinking that the recent past points us to future outcomes. Furthermore, we should never fall into the trap of thinking that a winning investment strategy is to pick what has just done well and avoid what has just done badly. Following this path is highly likely to result in great disappointment. In closing, I think it would be sensible just to reflect on these wise words written by Charles D. Ellis in his excellent 2002 book, Winning the Loser's Game, where he says, the hardest work in investing is not intellectual, it is emotional. Being rational in an emotional environment is not easy. The hardest work is not figuring out the optimal investment policy, it's sustaining a long term focus at market highs or market lows and staying committed to a sound investment philosophy or policy. Holding on to sound investment policy at market highs and market lows is notoriously hard and important work, particularly when Mr. Market always tries to trick you into making changes. Thank you for listening to the Purposeful Wealth podcast.
Thank you for listening to Purposeful Wealth. Please remember to subscribe, review, and come back next week for your next instalment. You can also visit the wellsgibson.uk website for more information on bringing clarity, contentment, and certainty to your financial life.